Welcome back, everyone. This is episode 156. In this week's episode, I'm joined by Shauna, the tax goddess. Welcome, Shauna.
Aw, thanks so much. I'm so happy to be here.
Me too. And this week, we're going to discuss some tips for high-earning LLCs, how they can save money in taxes. But before I get into that, just a quick reminder, as I mentioned for the last couple of weeks, my online retirement planning class is now live. So if you want to put together the best plan for retirement, what to do with Social Security, Medicare, taxes, and much more, head over to retirewithryan.com/on-demand, and you can check out my new course. So Shauna, we were talking earlier, and one of the things you mentioned was what a CPA versus a tax strategist is. So tell the listeners a little bit about that.
Absolutely. We get this question all the time, right? Well, Shauna, that's great. You're a tax goddess. That's fantastic. But I already have a CPA. Oh,
Sure.
Totally get it. Totally get it. So in my world, there are 4 legs to the financial stool. Okay. You've got a bookkeeper, you've got a CPA, you've got the financial advisor, and you have a tax strategist. And if you're missing any one of the legs, your stool just isn't quite as stable as it could be, right? You might sit on it and kind of fall over to one side. So the way that it should flow, right? You have your bookkeeper. Bookkeeper's doing day-to-day stuff, right? Paying the bills, inputting things, reconciling. Okay. The next in line is actually your tax strategist, because the tax strategist looks at your entire world, all the finances. Where are you spending money? What are you doing? How are you investing your money from a tax perspective, right?
Sure. Yeah.
And how can we tweak those things so that by December 31st, when the year is over, you are reporting the lowest amount of profit possible and keeping the largest amount of money in your pocket.
Sure.
So whatever is done by December 31st, we then hand that over to the CPA, and the CPA prepares the tax return, right? Ships it off, protects you from audit, make sure you're not breaking any rules, getting everything filed. And then, of course, we have the fantastic financial advisor, right? Now that we've saved all this money, what do we want to do with it, which is the fun bit. So, the tax strategist, many people, maybe the easiest way to explain it is that when you've gone to your CPA and you said, okay, I'm not happy with how much in taxes we're paying, what else can we do? There's typically 2 things that they tell you: form a 401k or buy a car, right? Those are kind of the 2 low hanging. Now, I always bring this up because you don't need 10 cars, right? At some point you're going to end up with a fleet. Okay. 401k is great if it fits your situation. 401ks are fabulous, but at some point you're going to run out of cars. So you need more strategies. You need things that are different that can apply, that will keep that money in your pocket and not hand it over to the dealership, or worst yet, to the IRS. So,
sure, not to knock some, CPAs. I have friends that are CPAs. I refer clients to CPAs, right? But a lot of them, they're just, that's not their job, is to do tax strategizing, because they just get paid to file the return, right? They're not getting paid to check in 2 or 3 times a year with their clients and figure out, okay, how's the business this year? Should you be doing this or that, right? And that's what we're going to talk about in this episode. But it's just, I try to do that as much as I can for my clients as their financial advisor, because I am a little more tied in, than a CPA might be, because we're talking during the year. Right. And there's things I can recommend, but some of this is still, you need a strategist who just does that, I would say.
Absolutely. Your CPAs, it's April 15th. I can promise you, they just don't have the time to read the 167,000 pages of IRS code, right?
Sure.
And that is the entire job. I'm a CPA as well. I've got my own tax seasons, right? But that's the job of a tax strategist as a specialist. And that's why we work with your CPA. They can work on filing the returns, and we can help you work on the strategy. So
sure. Yeah, makes sense. So let's jump into these tips. I have 5 down here. Hopefully we can get through all of them.
Ooh,
5 tips for high earning LLCs. So just define, in your mind, what's a high earning LLC?
Absolutely. So generally, when we're looking at, and it could be an LLC, it could be an Inc., it could be a partnership. So any of the business structures, generally a gross revenue of 1 million or more. Okay. Net take home 300,000 approximately, and taxes being paid at about 100,000.
Okay.
Yeah. And so, one of the most important questions that all your audience, everyone needs to have in their own heart and minds is what is the aggression scale of the business owner. Okay. Now,
Okay.
aggression scale, I'm talking about tax strategy here. We know that you've got an aggression scale on the financial side. How risky do you want to be with your portfolio?
Yeah.
Very similar in the tax end. And really, what we're looking at is every strategy in the tax code. So we look at about 400 strategies at the federal level, plus thousands at the state and local level. Okay. Every strategy has its own aggression scale. So 0 to 10, 0 meaning the IRS will never call you never ever, except for random audit, and 10 mean we're all going to jail.
Okay.
Right. So most of us do not want to be at a 10. Okay. Yeah. I have had some people say 20 and like, we're going to fly to Belize. And I'm like, find a new strategist. I'm an 8. Okay. I'm an 8 by both training and by nature. Now a 9. So let's walk backwards. A 10 is we're all going to jail. A 9 is we're doing shady things and we're hoping we're not getting caught. So this is like Al Capone. Okay, of course, he got caught for taxes, right? Is the thing. That's a level 9. A level 8 is you might get a call from the IRS, but you have all the backup, all the court cases, all the documents, step by step. You're following, crossing the T's, dotting the I's, right? All of the things. Okay. So really the difference between an 8, a 7, a 6, going down that scale is just how willing are you to talk to the IRS? You're still in the right. Everything's above board. Okay.
Sure.
Now, the reason why I bring this up is you have to know your team. Okay. So if you are an entrepreneur and you're level 8, but you ask your CPA this question and they say 2, you're not even being given the strategies that you could have done, right? I mean, they're filtering it before you even hear about them. What I'm going to do is I'm going to give you guys the aggression scale of each of the strategies as we talk through them. Okay. That way, when you have in your mind, like, okay, listen, I'm a 6, my wife is a 4, so the family household is a 5. Do we do this or not do this? So you can kind of decide where you want to be. Okay. So one of my favorites, absolute favorites, and it's definitely a level 8. Okay. There are versions of this that can be a level 4, but they don't produce quite as good results as the level 8 one. It's your choice, either way. This is called an 831B, and the technical name is 831B. It's more commonly known as captive insurance. Okay. Now, I want to make sure that I am distinguishing because there's the dirty dozen, the IRS dirty dozen list version of this, and there's the good version of this. Okay, so we'll do a distinction here. An 831B program, in my mind, is a war chest. Okay, this is a way for your business to get a massive deduction. Typically, it's around 15% of whatever your gross income is. So if you're making $1 million, it's $150,000 right off the top. That is not taxable, ever. Not taxable, ever. Yeah. So sounds your good. Business, I'm in. Let's go. I actually have this. I love this strategy. So your main business gets a deduction for insurance premiums. Okay. Now the insurance must be for a valid risk, and this is where people get into trouble. So we're going to come back to this, the valid risk piece. Okay. But assuming you've got a valid risk, that money will go into your 831B company. It's a new C corporation. C corporations, insurance C corporations, do not pay tax on premiums. Okay. And it's because they're holding the premiums. Well, what if there's a call on the insurance? What if that risk happens and they have to pay it out? Right. So it's not taxable over here. Okay. Now, a couple of things here, right? This money inside the C corporation, inside the 831B, never taxable, ever, ever, ever. You as the owner of the insurance company can take loans against this money. Okay. You do have to pay yourself interest. Current AFR is about 3.5, somewhere in that range. Okay. But it's a lot cheaper than paying a bank 7, 8, 9%, whatever they're asking right now. Sure. Paying credit cards. Maybe you're trying to pay off some credit card debt at 25%, right? It's a lot cheaper. So we call this a war chest because, so first you got the $150,000 deduction. You're not paying taxes on that at 30%. That's $45,000 of extra money sitting in your account. Okay. And you have access to the $150,000 that you can now use to pay off other things, right? So we're in love with this strategy. It's a fantastic way. And if you never need the money, you're literally building up a war chest to buy real estate or use for retirement in the future or build a new business, whatever it is that you want to build. So pretty cool on that front.
So questions about that. A lot of questions. So
lots of questions.
What risk? I mean, you're talking risk of death or risk of, health? Like what?
Let's talk about it. Let's talk about it. So as I mentioned, there's the good kind and the bad kind, right? There's the IRS doesn't like this, and then there's the good ones. Okay, so I'm going to give you two examples, famous examples. The first one, we've got a caterer who caters to the Major League Baseball teams. Okay, he buys hundreds of $1,000s worth of food. Okay, so here we are. It's February of 2020. Okay, he just bought $600,000 worth of food for spring training season. Okay, and guess what? Everything was shut down due to COVID. Right. $600,000 worth of food spoilage. He went to his insurance company, State Farm, Farmers, whoever, and said, I've been paying you for 35 years premiums. Help me, right? Pay me.
Yeah.
And they said, no, act of God. He was just out $600,000.
Yeah.
So what did he do? He went to his captive insurance company and said, I have an act of God policy. Pay me. And it did. Right? It gave him the $600,000. So that is a good, valid risk. These are real business risks. Okay. Sure. Now, you can do it for health insurance risks. You can do it for key man insurance. You can do it. It's any kind of valid risk that a business might have. Okay. So the negative side, the bad version of these, and this is my favorite example. This was the court case from the IRS. Rancher, 5,000 head of cattle. Okay. His cattle were up on top of a mesa, which is like a mountain with a flat top. Okay. Sure. He bought flood insurance. And the IRS came in and said, well, unless it's a biblical flood, no. Yeah. Like this is, it's never flooded there in like all of recorded history. So the answer is no. Okay. So you can have good kinds and you can have bad kinds. And really with the 831B, it all comes down to, is there a valid risk? And this is why I said that the aggression scale can either be at a level 4 or it can be at a level 8. There's two different versions even of this strategy alone. You guys can see how complex this gets, right? There's all these things you need to know here. The level 8 version of a strategy is risks that you as the business owner know for sure. Okay. So for example, our Tax Goddess tax strategy program has a guarantee. If you do what we tell you to do and you don't save at least 3 times of what you paid us, we will write you a check for the difference. Okay, that is a warranty. That is a real valid risk that I know. I don't need anybody to tell me that I have a real risk. That's a level 8, okay, because I'm the one choosing the risk. Sure. If you're a level 4, you can actually hire specific people that will, like actuaries, that will create your risks for you. So you're getting a third-party sign-off on what your risks are, which take this strategy from a level 8 to a level 4. Because now you have a third party telling you how much those risks are worth. So
if you're like a professional service company, let's say like you're running a financial planning firm like myself. I mean, I guess, there's probably information out there about what the risks are of that, right? That you could do. Like, what's an example of one?
What happens if you get hit by a bus tomorrow? Sure. Yeah. Who's going to run the practice? What's going to happen? I mean, that's insurance. An easy one.
Yeah.
Keyman
insurance. So that would be Keyman. So then what do you do? Like if Keyman insurance normally be like, your salary, essentially, that's what you're putting away.
Yeah. So normally what you'd be looking at
to pay somebody to step into your shoes.
What would you have to pay somebody and how long? Right. You might not buy a 20-year Keyman because at that point you would have closed the practice or sold the practice. But a 3-year Keyman? Yeah, maybe. Right. Yeah. Maybe.
So then that would be, so does this money then go into buy the insurance or does it go into like a fund that you invest or something?
So what you're looking at with the good kind of 831B programs, you're looking at something called pooled risk. Okay. So it just so happens you and I are both professionals, right? So we have the same key man issue here. Okay. Yeah. So if you set up an 831B and I set up an 831B, the company that we choose to organize all of this for us, they will pool the risk. Okay. So you're going to put some into that fund, the group fund. I'm going to put some into the group fund, and Bob over here is going to put some into that group fund. Well, if Bob gets hit by a bus, you and I will have to come out of pocket from our programs. Okay. But for example, this is a live example because I have one of these. Last year, I think we paid out a total of like $123 across like 3,000 people that are in this pooled risk because there's such a large pool. It's not like you're coming out with 500,000, right? It's like a little bit. But the pooled risk portion is what allows this particular strategy to be considered valid. because
Okay.
you are at risk. It's not just you making up risk again,
Sure.
right? It's a
Yeah.
valid
It's a real
risk,
risk. Yeah. Yeah.
and you
It's a
actually have to
different
pay
way to
stuff
do it.
out for somebody else that's in the
Yeah.
pool. So yeah,
Okay.
yeah, great
Interesting. Yeah. I'm
question.
sure there's a lot more to that, but
Oh, there's a lot more
that's
to it.
the tip of the tip there.
Yes.
So, all right, should we jump on to the second idea?
I'm in. I'm in. So the
Okay.
second one has to be one of my favorite ones in all of the tax code. Okay, and it's been getting a ton of publicity right now. So sometimes you're going to call it heard the master's exemption. Sometimes it's going to be called the Augusta rule. Okay, so those two things are the same.
Okay.
They're the same thing.
As
And
in, when I heard masters, as in the masters, right?
I was about to say, I do see the
Okay,
little
I'm a
golf guy over
golfer.
your
So you see
shoulder
that right there.
there.
Yeah. Yes.
So, and yes, you're right. That's exactly where it
Yes.
came from, right? Our golf people know the Masters tournament is held in Augusta, Georgia.
Yeah.
So, the one thing I love about being an American, right, is if the government writes a rule for itself, that is the same rule for us too. Okay. So
We
here's
hope.
what happened. Well,
Not quite.
without the
but-
political conversation, right? Totally different issue.
Yes.
But in general, right? This is the rule. So the way this actually happened was in Augusta, Georgia. You have a bunch of very high wealth politicians, senators, congress people, whatever, and they own homes there. And what they did and what they wanted to do was rent out their home to other people 14 days or less a year. And
Sure.
the rule that they put into place for themselves is if you rent for 14 days or less, all of the income is 100% tax free. Great. I'm doing,
Sure, yeah.
except for the fact that, like, I don't want random people in my home. Like,
Yeah,
that
yeah.
doesn't just, they're going to rip out the
Yeah.
copper and destroy the place, whatever. Now, the way the law is written, which is my favorite piece about this whole thing, is that it just says someone separate from you. Well, if you have an LLC or partnership or an Inc. or an S corp, that is technically a separate entity from you, right?
Okay.
Which means that your business can rent the space in your home for up to 2 weeks a year. Business meetings, mastermind meetings, client meetings, prospect events, whatever it is. Okay. Now, it does have to have a business purpose, 100%, right? You got to have a business purpose. You do need to have proof. So I would take some selfies, with all the people.
Take some notes.
Take some notes, have an
Yep.
agenda, this kind of thing. But you are allowed to look at what the fair market value of rent is for a similar space at a local hotel, conference center, restaurant, like whatever it is that you're doing. Okay. So I'm going to give you a couple examples. I live in Arizona. I've just bought a new house last year. So I have my old rate and my new rate as an example
Sure.
here. My old house was in like Scottsdale. It's like an 8 out of 10 city in the valley. Okay. My rental rate per event was $3,500 per event. So at 14 events, it's a $49,000 tax deduction every single year that I don't have to pick up as income, and my business gets as a deduction. So not
Wow.
only do I get the cash flow, I also
Pretty
get
awesome.
the taxes back. It's like double dipping. Like, why would you not? This is
So what level is this on the scale?
yeah.
9?
This actually is like a 2. Which
Okay.
is awesome. Okay. Yeah, as usual, it's a 2 if you follow the rules, right? You must
Yeah.
follow the instructions, right? And all of the strategies are like that, right? If you do it wrong, then it's a 2,
Sure.
9, 10, whatever, like it's no longer a 2. But yeah, so we have clients, the highest rent that I've ever seen in the entire country was $17,800 per event. Okay. $17,800. I'm going to run it right now. 17,800 times 14 is $249,200 off your taxes. Okay. The lowest rent I've ever seen is $500 per event. So at a
Was
minimum,
that 17,000? Was that a president or something?
no,
That's
that
not the White
was that was Manhattan. That was Manhattan.
okay,
That was New
okay.
York. Yeah, so
Pretty
New York,
sweet penthouse.
California.
Yeah, $30 million penthouse, right?
I was about to say, I'm like,
pretty
the White
expensive,
House
yeah,
might
to
be
rent
the
that.
next thing.
Yeah, to rent that out per day. Yeah.
Taxpayer
Okay.
budget. Yes. So yeah, to me, this is one of the ones that, like I said, it's a level 2. Most
Yeah.
CPAs just don't even know about, or they don't pay attention to, or they
Sure.
just don't know. And so it gets missed. But for many business owners, you have staff, you have teams, you have vendors, you have crews, you have people that you could hold a mastermind once a month in your house, and it would be legitimate. You'd be talking about business, going over the monthly agenda, like whatever
Yeah.
it is. This is very easy to accomplish, but most people just don't even know it exists. So
So you're not even, you're spending a little bit of money, maybe, right?
You could
maybe
buy
not
some
even,
drinks and a
but
cheese
yeah,
plate. I mean, like,
exactly. For
whatevs.
$100, and maybe you're charging yourself $1,000 a
Yes.
day, to have it at your house, which is what you'd pay in a conference
In a
center,
conference
right?
center. Exactly.
Easily, for not even a very nice one.
Yep.
So how do you determine the value you're going to use? What does the
Yep.
IRS
So you
recommend?
absolutely want to call, in my world, we tell clients, call 3 places, right? As
Okay.
close to you as you can. Okay. So the
Yep.
nicer the neighborhood, the nicer the hotel, the more expensive it's going to
Sure.
be. Okay. But as close to you as you can that have similar facilities. So let's say, for example, your house is 2,000 square feet. Well, you're not going to have your business people running around through back bedrooms, right? So we're going to take
Sure.
off 800 square feet for bedrooms and bathrooms, and like that's all going to go away. Okay. So we got 1,200 square feet. Well, if I went to hotel, conference center, whatever the inn, whatever it is,
Yeah.
to try and find it, I'm going to get 3 prices in writing, get quotes, faxed, email, whatever, in writing. Okay. And then you can either take the average or you can take the median. Either
Okay.
one, right? One of my favorite sayings is pigs get fat, but hogs get slaughtered.
Sure.
Don't pick the biggest one. Okay.
Yeah.
Pick an average, do something in the middle. And then what I would absolutely recommend is that you redo that research every single year. Okay. Because if you look at, for example, if you had done this research in 2020, the rental rates in 2023 are almost triple at this point.
Oh, are they?
Right.
Yeah.
Well, the hotels didn't have any income for 2 years. So
They got to
trying
make it up.
back.
I've heard weddings are crazy. Like wedding prices now
Couldn't
are
even
like
imagine.
double, triple what
Exactly.
they used to be. Yeah. They're
Exactly.
charging. Yeah.
Trying to survive. They're trying to
Yeah.
make
Trying to
money
make
back.
back up what they lost. Yeah.
Yeah. So I'd recommend redoing that research every year. Stay on top of it, get an assistant or somebody, like go do that, call those same 3 hotels. What is it this year? This kind of thing. But yeah, you want to have the proof, you want to have the backup. And really that's what goes into all of the strategies, right? Like the next one is paying your kids, getting your kids on payroll.
Yeah.
Most business owners, so the kid just needs to be older than 7. Okay.
Oh, that's the minimum. Okay.
That's the minimum. Yeah, they've got to be older than 7. And you can do it under that. And if we have time, if you want me to, I'll go into the under that thing, but it's pretty rare. So 7 is kind of the baseline. Okay.
Sure.
They got to be 7. They have to do a job, sweep,
Yep.
shred, whatever. Go take this to my
Make
secretary,
coffee.
like whatever, right? Go run errands. You're
Drive my
allowed to
car.
pay. Well, when they're 16, I'll tell you what, I've actually had clients do that where the child becomes the chauffeur and you're doing work in the seat and the kid's driving you around. Like that counts.
That's a good one. Yeah.
That's a job. So you're allowed to pay the child whatever you would pay a professional adult for that. So for example, cleaning where I am is somewhere between $30 to $40 an hour.
Sure.
You can pay your 7-year-old $30, $40 an hour. Okay. Now, the maximum amount that you can pay a child between 7 and 18 is going to be for 2023 is $19,850.
Okay.
So if you've got 3 kids and they're all over the age of 7, you just effectively gave yourself a $60,000 write-off, and the money stays in the family, which is awesome.
Well,
the kids
that
pay no
number
tax.
Is that up to like the kid tax rate? Is that what that number is?
So
Or the
it's
zero
interesting.
tax?
Yeah, it's
It was
zero
lower
tax
than
for
that.
the kids. It is, but when you add a $6,000 IRA, you start setting your kids up for retirement, right? Now we've got
So
$19,850.
that $6,000 IRA, is that a Roth IRA or traditional IRA?
In order to make it deductible, it would have to be traditional. However, a lot of my parents will go the Roth route because the kid is getting taxed at the kid's rate, not your rate. So on $6,000, it's like 10%.
Okay.
Whatever.
So
Pay the
plus
$600 to
state,
make it
if there
raw.
is. Yeah. Okay. Yeah.
Yeah.
But you could also just do it underneath. It's like 12,000 or 13,000.
Yeah, it'd be $13,850.
And that there'd be no tax due, and then
no tax.
You could just take the Roth out of that, right?
Yep.
Yeah.
Absolutely.
Okay.
So either way, one half dozen the other. What we do see is some parents, because the one thing I love about paying the kids is that the kids, this is now the kids' money. It's not your money. Okay. It's not your piggy bank. It's the kids' money. But the kids, the only thing that a parent is not allowed to charge their children for is food,
rent?
clothing, and shelter.
Oh, yeah.
Right. Food, clothing, the 3 parental duties, you cannot use that money on food, clothing, and shelter.
Okay.
But kids have summer camp, day camp, iPad, 16 dad, I want a car, lease payments, cell phone, blah, 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 blah. We all know that one cute little one is a lot more than $19,850. Like,
Yes.
they just are. So, so for a lot of my parents, they'll actually raise that salary, right? Whatever they can justify with the jobs, they'll raise that salary 45, 55. I've got one parent at almost 120,000 a year because the child is running the social media platform.
Oh, wow.
Which
Okay.
is very expensive, right? It's like $130 an hour to hire an SEO person, right? So,
Sure.
so really depending on the job. Yeah.
Okay, cool. What's next?
Roll to the next one. I was going to say, when you have kids, you often have dogs, right? Those two
Yes, that
things
was on cue. Yes.
tend to go together, kids and dogs. So with a dog, all right, now many of us know that if you have a medically trained dog, that is a medical expense, right? Glucose
I
sniffing
didn't know
dogs,
that,
cancer
but I
dogs.
guess that
Oh,
makes sense. Yes.
okay, yeah. If it's a medically, specifically medically
Like if you need a seeing eye dog, right? If you're visually impaired, like
exactly
that qualifies towards a medical expense, as long as you can deduct it, right? It does have to be over the 7.5%.
Still have to be 10% now.
Or if you're over 65, right? Is it 7?
Oh yeah, it depends on the age.
But 10% for a lot of people.
So whatever medical is, right? Let's put it that way. And PTSD dogs, eye dogs, glucose dogs, like any where they're medically trained for whatever that is. But for most of us, we don't have those kinds of dogs, right? We have Fido, and he's cute, and he barks at the mailman, right? Like that's the kind of dog we have. So there is a separate way to write off your dog. Okay. Now there's a few qualifications. Okay. The dog at its shoulder has to be taller than the height of your knee. Okay. So we're not talking a Chihuahua, German Shepherd. Okay.
Yeah.
A boxer, right? Big dogs,
Sure.
right? You're good. You meet that qualification. Second qualification, it must be trained. Now that's a very vague word, right? We're not talking Schutzhund here, like going up the trees and things, right? I mean, we're talking sit, stay, come. The IRS left it very broad, trained, okay? And the third one is there must be a business purpose for the dog, okay? So for example, Ryan, if you're going to a client's home to visit with them, right? Security, if you take that dog with you, it's protecting you when you're in somebody's home. Or these 14 events where people are coming to your house, I'm sure that dog is barking at the doorbell, right? It's providing security, right? So as long as you have a business purpose, a business reason that the dog, some people will go the marketing route, right? They have their dog in every picture of every flyer of everything they ever do, right? We've seen YouTube stars that are dogs, right? I mean, this can absolutely be a thing, okay? So in that case, if you qualify, you're talking food, treats, training, vets, grooming, nails, shots, all the things. Okay.
Sure.
All the things. Yeah. So
those are all business deductions.
They all become expenses for the security dog.
Yeah.
Exactly.
So that would just be a bit like a business expense, right?
Exactly. Yep. You'd literally use your business card to run those expenses, and that's that. So nice and easy. Yeah. But most people really unfortunately, we can't write off all the food for the kids. We got to do that through the wages, but most people like the dog one. That's a thing. So.
Yeah, no, that's pretty neat. Yeah.
And I got one more. Do you want one more?
All right, let's do one more. Yeah.
One more.
You said 5.
Yeah, we got to make sure we get to 5. I love it.
Yeah.
Now this one is one of the things. Oh, and I'm so sorry. I didn't give you aggression scale. Let me go backwards. Paying the kids, as long as you're, again, following the rules, they have timesheets, they're doing all the things. Again, you're at like a 2. The medical dog is like -2. Like if you have a medical dog, you're totally good. If you have a business dog, you're probably at like a 4. Okay. It's a little bit more. It's like a 4. The last one is a -2. Okay. This is like, if you're not doing it, your CPA just flat out missed it. Okay. So -2. This is called an accountable plan. And when I take polls, I speak to thousands of people in audiences all the time. And when I take polls in the room, typically there's like 4 people that have even heard the term accountable plan. And it breaks my heart because this is one of the most abused strategies in the tax code because it's just not being done right. Okay.
Sure.
So an accountable plan has 2 pieces. The first one, every CPA is getting correct. The problem is they're missing part 2. And without part 2, the IRS can take away the deduction.
Sure.
Okay. So part 1 is expenses, which we're going to go over here in a second. Part 2 is that you actually have to have an accountable plan document in your files that says, if I have this type of expense, The business is allowed to reimburse for it and pay for it. And this is the plan, and it applies to all employees. So if you got 50 people on staff, everybody on staff, right? It's all the employees. Okay. Accountable plan, the expenses. How many of you are taking home office? Personal use, like business use of a personal vehicle, business use of your personal cell phone. Okay.
Sure.
You went and bought donuts today, Ryan, right? You went and bought donuts, but you put it on your personal card. You forgot to pay for it on the business card, but you bought them for you and your assistant. Okay. These are things that you're spending personal money on that are on behalf of the business, right? Your home office is only because you have a business. This is the point.
Yeah. Yep.
So most CPAs are writing these things off, right? They're asking you, what did you spend personally that was on behalf of the business? Let's make sure we report that on the business tax return. But if you don't have that accountable plan document and the IRS comes to look, they will take it away. All of it.
Okay.
Now, the worst case I've ever seen, $190,000. CPA had done everything right on the expense side, but didn't have the document. IRS came in, went 7 years back, and took $190,000 worth of deductions away.
Oh, wow.
So, yeah, you gotta have part two. You have to have part two. And, so many CPAs, so I'm going to hit on home office here just for a second because it's a part of this accountable plan.
Yeah.
So many CPAs will ask for the basic things. Give me your utilities, give me your power, give me your water, your trash, this kind of thing.
Right.
What if you remodeled your kitchen? A percentage of that, a percentage of every penny that you spend on the house belongs on the accountable plan. Even if it had nothing to do with the business, it was an expense of the house. So repairs and maintenance, the air filters that you replace every month in the air conditioning units, right? The remodeling the kitchen, installing landscaping, installing a pool, fencing, all of that kind of stuff.
Okay.
All of it. So it's a percentage of any penny that touches the house. So we've had multiple cases in the past where somebody's, I live in Arizona, so everybody puts in a pool, right? Sure. Multiple cases where, I put in a pool and the CPA said not a penny of it is deductible. Like, well, for $180,000 and you have a 10% home office, it's an $18,000 deduction. Let's go get it, right? And we will amend tax returns to go get that money back. So
this accountable plan, what do you mean? This is like a written document that you need to have?
Written document that you need to have. Okay. Absolutely. Yeah. So, and it's not big or complex or anything else, right? It's a very simple document, but if you don't physically have a document that says, I, Tax Goddess Company, allow any and all employees to ask for requests for reimbursement for like these categories, and they are pre-approved up to, you can put in limits like up to $10,000, or you can just say pre-approved period or whatever it is. And you actually have to do the reimbursement in a perfect world at least every quarter. This is the other piece that the CPAs miss, right? They make an adjustment on your tax return saying, just give me all the numbers and I'll just add it to the return. Well, if you never moved money, it wasn't really a reimbursement, was it?
Sure.
Yeah.
Okay. Interesting. Awesome. just a few things to think about, right?
Just a few. Well, and I think, you hit the nail on the head earlier when you said, like, this is just the tip, right? And I think this is why so many CPAs, every CPA wants to do a good job, right? As I mentioned, I'm a CPA. We love educating. We want to do a good job. We're fiduciaries for our clients, but there's so much to learn that when you're face down doing tax returns, you just don't have the time, energy, effort. It's April 15th at 10 o'clock at night. You're not reading tax code. You're just not. There's just not enough time, right? And that's where an expert comes in. We get that question so often. Well, do I have to switch CPAs? No. If your CPA is doing a good job, they just don't know this stuff because they don't have time. That's where we work together as a partner, right? Yeah. 4 legs on a stool, and we all work together. So
sure. Yeah. So if people want to get in touch with you, how do they do that?
Super easy. Taxgoddess.com. We're super easy to find. And if you're looking for more education, we have a YouTube channel as well. And we have a group coaching. If you're looking for more of like a lower cost, but you still want tax strategies, we've got group coaching. Happens every Wednesday. And so lots of ways to get tax strategies for you and your business.
Awesome. Well, thank you very much for coming on today, sharing some great tips. Yeah.
This was way too much fun. So thank you so much for allowing me to do my favorite thing and educate.
All right. Perfect. Well, thanks everyone. And as always, if you have a listener question, you can always go to retirewithryan.com to leave that question. Look forward to talking to you next Wednesday.